Hello everyone. Here in this video, we will be discussing how to understand a market profile chart, how to construct the market profile chart, and what are all the technical terms that are involved in market profile chart. So for a price action trader, as you all know, this is a Japanese candlestick. So in a Japanese candlestick chart, how it is formed, you have this on y-axis and you have time on x-axis. So on x-axis, for each and every time frame that is selected, like here it is 30 minutes. So for each and every 30 minutes, there will be a candlestick. So if it is 5 minutes, 5-minute candlestick will be there. So how price action traders mainly trade is they don't consider time into trading. Whereas in market profile, there will be a time component involved and volume component that is involved. So in a price action trading, so there is a breakout here. So the breakout is that there is a pullback and there was a lower low made. So previous low has been broken. So this becomes the entry point. The time component is not being considered. Somewhere in 1985, a person by name Peter Stadelmayer, he introduced this market profile. He was working as a trader in Chicago Board of Trade, so CBOT. What he tried to do is he tried to make sense of whatever the prices that are happening in the intraday. When he took the time component into consideration, he had observed Gaussian curve whenever the prices are completely rotating around that area. So at that time, he observed that the prices are being attracted towards that value. So let's understand what does Stadelmayer means is here there is a strong value here and the prices went up. How far the prices will go? Once the momentum in the market goes, automatically the prices revert back to the value. So a market profile chart looks like this. So what happened here? So instead of candlestick, we have, so this is the yesterday's candle. This is the yesterday profile. So if you look at here, I'm just unhiding the candlestick. So instead of a candlestick, we have something called time period. So the time period and candles both have the same rate. So the high and low will be the same at the top candlestick. And the only difference is that it doesn't have the market profile time period, doesn't have any kind of wick or body, anything. It's just a plain A time period. So why A time period? The first starting time period, we call it as A. So 9:45 to 10:14, 10:15 to again so on. So by 3:30 you have total 13 candles. So A, B, C, and the last 3:15 will be M time period. So what happens in this time period also, there is something called, this time period is subdivided into small structures, small boxes called TPOs. TPO means time price opportunity. So what is time price opportunity means? At any given point of time, opportunity is being presented for a trader. Now don't go deep into this. It's as simple as it. Let's see how this is divided. If you look at here in this candle, in this time period, A time period, there are multiple A's. So what does it mean is, here there is some settings called TPO settings, which I can show you here. My TPO settings is 5 here. So what happens here, for each every 5 points, one A will be formed. So let's say if this is 100 points, there will be total 20 into 5, it's 100 points. So 20 TPOs will be there. So B time period, again, if it is 50 points, you will have 10 time periods, so on and so forth. So color, sometimes it will be color, sometimes it will be A, B, C, D. So it doesn't matter if you understand how it is constructed. So color is because when the TPO size becomes too small, so color will be represented. Now what we do here is this market profile, we have to overlap all the time periods, whatever are there. So here on A time period, you have B time period, B time period, you have C time period, on C, you have D. So this is the split profile. Split profile in the sense everything has been splitted as per candlestick. Now here we need to understand here few technical terms. So the technical terms are, let's say, the gray area, whatever you are looking at is nothing but the value area. This is the 70% of the time prices are spent. The high of value area is called as value area high. Low of value area is called as low value area low. And the lowest portion where there is no overlap at all, 2L time periods, this is called as buying tail. So minimum 2 type TPOs has to be for a valid buying tail. At the top, at the same time, minimum 2 TPOs has to be there for a valid selling tail. So what is buying tail? What is selling tail? It means this is where the buyers were able to hold their levels. So in a downtrend, what happens? The buying tail itself keeps on extending downside, whereas the selling tail will be strong. So let me unhide the candle so that you will understand much better. So what happened here? So selling, the high of the day has never been broken, and the low of the day, here there is only one TPO and the prices went up, pullback is there, and then prices came on breaking the downside. So continuously the buying tail itself is continuously being broken, which means that here the buyers are not strong. And what also this means is the sellers are strong because selling tail is not broken. So continuously value had made lower lows, and we have something called POC, point of control. So what is point of control is, this is where the area maximum amount of time prices has spent. There is something called initial balance. So what is initial balance again? So this is not the first 1 hour range. First 1 hour range is called initial balance. So when you can understand this first 1 hour, you can set the tone for the day most of the time. So at the same time, the low of IB is called as initial balance low. The high of the IB is called as initial balance high. So why this IB is important? Again, as I said, the length of this IB, the range of this IB is important. And at the same time, it is also important, this initial balance is nothing but my balance which I have bought into the market when the market opened in first 1 hour. So what it means is, let's say I'm a seller. The moment market opened, I sold something. I sold something very good amount. So let's say for 1 crore rupee, and my average price is somewhere here in the middle of the first 1 hour. So if I want to make profits, the prices has to at least move more or less equal to the IP. So if the price is pending here itself, I might be able to make the profits. So what I should do, the prices should go further down. So I am a directional trader. So since I am a directional trader, the prices has to move away from the IB. So if the prices keep on getting here, I may not make much money because I'm not a market maker. Whereas a market maker, even the prices is within the first 1 hour or within 5 points also, he will make the, how he makes the money. This market maker, he is called as a non-directional trader. He just makes the market. So what is market here? Marketing process. So let's say I'm a buyer here. I placed a 100 order, 100 at 100 price, and a seller placed at 101. So he places 100.10 buy order, and he also places 100.90 sell order. Now you remember, these are limit prices, and a market order gets executed at bid and ask price, the prices won't move. Now what happens here? A market order gets executed at 110 paise, and also one market order gets executed at 190 paise. So suppose if these two quantity, so this and this bid and ask are of 20, he is going to pocket that 80 paise difference into 20. So market has moved nowhere, but he pocketed that money. So that is how market maker makes money. But since I am a directional trader, so if the IB is very small, the prices has to go down for me to make money. So we call the market maker who are making money, we call them as local people, and we call the people who make when the market makes a direction as OTF people. So this market makers and OTF traders, they are opposite to each other. So if this OTF trader or directional trader wants to push the market downside, local or market maker, he opposes the action of the OTF trader or a directional seller. So here what is happening? Because the prices went outside the value area, there is a OTF buyer. So it means directional buyer. So the opposing activity automatically will be by the locals or market maker trying to push the prices downside into the value area. So why the prices still moves up is, whoever have big money in that day, they win over in the market. So here in this, it's the directional traders are in control. So morning the value area would be here, and then it would have moved up, and it would have moved by the end of the day up to this point. So the value area of previous day is a static one, and the value area of current day is dynamic. So it continuously changes. Also you need to understand the POC. is also continuously developing. If you look at in this example, morning the POC would be here, and then afternoon the POC might have raised, and then the POC by the afternoon and again came down. So mostly 2 to 3 times POC moves. So this POC itself tells us the sentiment of the traders at that point of time. You also need to understand the value area. They act as good support and resistance. So in a trending market, value area always expands, whereas in a non-trending market or in a sideway market where locals or non-directional traders are in control, the prices stays within the value. As the prices goes up, prices comes back, and as the prices goes down, prices goes back into the value area. So example is, look at this here. Strongly the non-directional traders are in control. So also you need to remember POC attracts prices in general terms. So just because there is a POC, it doesn't necessarily prices will go there, but it all depends on how strong is the value on that day. Value consists of three things. Value consists of three things. So first one is price. Second one is time. Third one is volume. So all these three included, it forms the value. So what does it mean? Price is a advertising mechanism. So what does it mean is, so let's say I am a seller. I have placed a limit order here of 101 rupee, and I am advertising to the traders saying that I am ready to offer my whatever the stock position is there with me. So that becomes the advertising mechanism. Whether it executes or not, that's a totally different thing. And time, how much time the prices spends there. So time and volume, again, both are interrelated. So how much time the prices spends there, the more value it becomes. So more volume automatically there gets built up, and then the value becomes stronger and stronger. So time is a regulating mechanism. How much time the price is spending there, that creates the more value. Whereas value is a validating mechanism. Whereas volume, in a low volume market, the prices behaves in a different way. In a high volume market, the prices behaves in a different way. All these three things included, we call it as value. This is with market profile basics, guys. In other video, I'll try to produce a few more concepts. Till then, thank you. Have a nice day.